Hi everyone, I'm Kingsley. In this video, I'm going to talk about the adjustment for intercompany sale of non-current asset when preparing consolidated statement of financial position for a group of companies. Let's assume we have a parent company called Alpha Limited which has acquired the controlling power of Beta Limited. So Beta is a subsidiary company. As an individual company, Alpha Limited should prepare its individual financial statements for Alpha Limited, and Beta Limited management should prepare financial statement for Beta Limited. In addition, as the parent company, Alpha Limited has the responsibility to prepare consolidated financial statement for the group by considering Alpha and Beta as those of a single entity. Now let's assume during the period Alpha Limited has sold an asset with the carrying amount of 6 million to Beta for 10 million. This transaction will result Alpha to recognize a profit of 4 million because the carrying amount of the asset 6 million which is sold to Beta for 10 million. So Alpha Limited financial statement can recognize 4 million a profit. So this 4 million profit is included in the Alpha Limited retained profit. On the other hand, as far as Beta is concerned, since Beta has acquired the asset for 10 million, for Beta cost of the asset is 10 million. So Beta's statement of financial position, non-current asset, recognize the cost of the asset is 10 million. But from the Alpha's group point of view, this transaction has no meaning because this transaction has no impact on the group financial position. From the group point of view, this transaction is merely a transfer of an asset from one place to another place in the same entity. There is no transaction. So when preparing consolidated financial statement, this profit recognized by the Alpha Limited should be considered as an unrealized profit. So the profit that has been recognized in the Alpha Limited statement of financial position 4 million is an unrealized profit. By the same unrealized profit, Beta Limited asset value has increased. So when preparing the consolidated financial statements, we need to eliminate this unrealized profit from the Alpha Limited retained profit because Alpha Limited is the seller. If there's an intercompany sale of asset and there's a profit is there, that profit should be eliminated from the seller's retained profit. In this case, seller is Alpha, so we need to deduct this unrealized profit from Alpha Limited's retained profit. At the same time, as a result of this profit added, the consolidated asset value has increased. So we should deduct this unrealized profit from the consolidated non-current asset. So this is the treatment if there's an intercompany sale of asset with the profit. So this unrealized profit should be eliminated by deducting from the seller's companies or selling companies retained profit and consolidated asset. There's another complicated issue when there's an intercompany sale of asset with a profit margin. That is the effect of depreciation. If the asset is a depreciable asset, the buying company will depreciate its asset based on the cost which includes unrealized profits. So accordingly, in this case, Beta will depreciate this asset based on its cost 10 million. But we understood in the previous slide, this transaction is not a real transaction from the group point of view. Had this transaction not been occurred, this asset would be depreciated based on the original cost of or original carrying amount of 6 million. So let's assume the remaining useful life of the asset is 5 years. So had this transaction not been occurred, this asset would be depreciated over 5 years. So annual depreciation would have been 1.2 million. But Now this asset is at beta. So beta, for the beta, the cost is 10 million. So their depreciation is 2 million. So you can see as a result of this unrealized profit, group annual depreciation has increased from 1.2 million to 2 million. So there is a surplus depreciation of 0.8 million. So this surplus depreciation has recognized by Beta Limited. So as a result of this surplus depreciation or additional depreciation, Beta Limited profit is reduced and Beta Limited asset reduced. So we prepare consolidated financial statement. We prepare consolidated statement of financial position by combining Alpha Limited individual financial statements and Beta Limited individual financial statement. So when preparing consolidated statement financial position, we need to adjust this additional depreciation. The effect of this additional depreciation should be adjusted, should be reversed. So treatment, we can add this additional depreciation to the Beta Limited or buyer of the asset. Beta Limited retained profit should be increased by 800,000. At the same time, consolidated asset value should be increased by 800,000. Well, now let's look at an example and practice how to tackle this adjustment for intercompany sale of non-current asset and its arising issues on unrealized profit adjustment for additional depreciation. So we look at the example. So what is the requirement? You can look at the requirement here. It is you are required to prepare consolidated statement of financial position of Alpha PLC as at 31st March 2020. So you are required to prepare consolidated statement of financial position or consolidated balance sheet. Right? So according you should have information about the parent company and subsidiary company. Okay, we'll now read the question objectively. Alpha acquired 60% of the ordinary shares of Beta several years ago. So Alpha is the parent, Beta is the subsidiary. When net assets of Beta represented 5,000 share capital and 3,000 retained profit. Fair value of non-controlling interest as at the date of acquisition was $4,000. Statement of financial position as at 31st March 2020 is given below. Property, plant and equipment of Alpha is 21,000 and for Beta is 14,000. Investment in Beta 6,000. So that is the parent company. In the parent company's statement of financial position, you should have investment in subsidiary because parent company has invested in subsidiary company called Beta company to acquire the control interest. So we have invested $6,000. Current assets 3,000 and 4,000. So total asset accordingly 30,000 and 18,000. Share capital of Alpha 10,000, for Beta 5,000, retained profit 16,000, 11,000 and current liabilities 4,000, 2,000. Okay, no problem. Total equity and total liabilities 30,000 and 18,000 for Alpha and Beta respectively. So this is the adjustment that we discussed so far. On 1st April 2018, Alpha sold one of machine to Beta for $5,000. The carrying amount of the machine as at the date of the disposal is $3,000. So Alpha has sold an asset for 5,000 when its carrying amount was 3,000. So you can see sale value of the asset is $5,000 and the carrying amount is 3,000. So this will result unrealized profit of 2,000. So this unrealized profit is included in Alpha's retained profit because Alpha or the parent company is the seller. So parent company has recognized a profit of 2000 in this retained profit. At the same time, as a result of this unrealized profit, beta company's property, plant and equipment value has increased by this unrealized profit of 2000. So this unrealized profit should be eliminated, should be removed from alpha's retained profit. We remove 2000, and from beta's or the consolidated property, plant and equipment we remove 2000. And there's an additional issue, another complication, that is depreciation. Because this machine is subject to depreciation, now beta should have depreciated this particular asset based on its cost of 5000, but from the group point of view, this machine worth 3000. So beta has depreciated this machine based on 5000. That's accordingly additional depreciation. You can say depreciation rate per annum is 10%. How many years beta has depreciated? You can see beta has acquired this machine 1st April 2018. Now the reporting date is 31st March 2020. So beta has depreciated this machine for 2 years. So what is the total depreciation beta has charged to it retained profit? 400. So beta's retained profit has been debited or charged by 400. So this should be reversed. So we can add this 400 to property, plant and equipment, and beta's retained profit 400. So this is the adjustment we need to make with regards to this intercompany sale of asset with a profit and result in adjustment for depreciation. We will now see how to do this some step by step. Well, we first draw the format for consolidated statement of financial position of Alpha. You can see in this format, for goodwill you need to show your workings, and for consolidated retained profits and non-controlling interest computation there will be several calculations and adjustments. So you need to clearly show your workings for these three elements. Before moving on to your adjustment, it is very important you clearly determine what is the parent company's control interest and the non-control interest. In this example, it is clearly given. Parent company has acquired 60% control interest, so the non-controlling interest is 40%. Then we will identify the net asset of subsidiary as the date of acquisition and as the date of reporting. We can draw a line, and at the beginning we can identify net asset of the subsidiary as the date of acquisition. According to the information given, as the date of acquisition, subsidiary company net assets represented by share capital and retained profit 5000 and 3000. There's no adjustment for fair value. So accordingly, you don't need to worry about fair value adjustment as the date of acquisition. So net asset as the date of acquisition is 8000. Then you will see what is the net asset of beta as the reporting date. As the reporting date, if you look at the beta company's individual statement of financial position, share capital is unchanged, is still 5000, but retained profit has increased from 3000 to $11,000. No fair value adjustment, so net asset as at the reporting date is accordingly $16,000. Now you can see at the time of acquisition of beta, its retained profit was $3,000. Now it is increased to $11,000. This increase in beta company's profit is called post acquisition profit. So we have post acquisition profit 8,000. Post acquisition profit of beta means the profit generated by beta or subsidiary company under the direction and control of the parent company. So after getting the controlling power of the beta under the direction and control of alpha, beta company has been able to generate a profit of 8,000. That is what we call profit, post acquisition profit. This post-acquisition profit is going to be adjusted by adding surplus depreciation resulting from intercompany sale of profit with an unrealized profit. This surplus depreciation should be added back to the subsidiary company, that is beta company's retained profit. So accordingly, for consolidation purpose, beta company's retained profit is increased to 11,400. That will result an increase in, again, post acquisition profit will be increased by 400. So post acquisition profit should be 8,400 for consolidation purpose. So accordingly, at the end of the reporting date, or as at the reporting date, the beta company's net assets will increase to 16,400 for consolidation purpose. Well, now we will move on to our three key workings. First, we will work for computation of goodwill. When it comes to compute goodwill, we will first identify the investment made by the parent company in subsidiary 6,000. It is appeared in the parent company, or that is Alpha Limited statement of financial position. Under non-current asset, you can find investment in subsidiary company 6,000, and you are given the non-controlling interest at fair value 4,000. So altogether 10,000. From this we deduct net asset as at the date of acquisition. We've identified this in the previous slide. Net asset as the date of acquisition 8,000. So accordingly, goodwill is 2,000. And we read the question, there's no information about the impairment. So the carrying amount of goodwill is 2,000. So you can put this 2,000 in your consolidated statement of financial position right now, right, as the goodwill, right. Then second working is non-controlling interest. There are different approaches to compute non-controlling interest. So we'll first identify what is the non-controlling interest as of the date of acquisition. As of the date of acquisition, the fair value of non-controlling interest is 4,000. To this, we should add non-controlling share of interest in the beta's post-acquisition profit. We identified in the previous slide beta's post-acquisition profit 8,400. From this we should give NCI percentage 40%. Accordingly, it is 3,300. So non-controlling interest as of the reporting date is accordingly 7,360. Alternatively, you can take net asset of beta as of the reporting date. We have identified the revised net asset of beta as of the reporting date 16,400. We know non-controlling interest means net asset of the subsidiary not directly or indirectly attributable to the parent company. So net asset of this beta limited as of the reporting date is 16,400. We can take NCI percentage 40%, that is 6,560. To this we can add NCI share of goodwill 40%. Then you can see you get the same answer. But first approach is more suitable. It valid for any scenario, right? Okay. So according to NCI or non-controlling interest as of the reporting date 7,360, we can take this onto our statement of financial position. Our next adjustment is consolidated retained profit. So consolidated retained profit, we directly take the parent company or Alpha's retained profit as appeared in the Alpha's statement of financial position, and there's an adjustment for unrealized profit arising from sale of asset, because Alpha has sold an asset keeping a profit of $2,000. So that unrealized profit should be deducted from Alpha's retained profits. In addition, Alpha is entitled to added or recognized alpha share from the post acquisition profit of beta, because post acquisition profit of beta is the profit generated under the direction and control of parent company. So post acquisition profit we identified 8,400 and alpha share is 60%, so it is $5,040. So altogether the consolidated retained profit is $19,040. There are no more complicated adjustments, so there are no need for doing for workings. All of the workings are very simple and straightforward. So we can move on to our consolidated statement of financial position. So we will first put the answers we got from our working. So goodwill we identified 2000 from our working number 1. You can take it here. And consolidated then second working is the non-control interest. We work for non-control interest and identified 7,360. And as working number 3, consolidated retained profit, we got 19,040. Usually you earn marks. You can expect more marks for these 3 workings. For all other items, you can adopt line by line addition. So we'll take property, plant and equipment. We take parent company property, plant and equipment, added subsidiary companies property, plant and equipment, and removal of unrealized profit and reversal of depreciation. So as a reporting date for consolidation purpose, the consolidated property, plant and equipment is 33,400. Current assets, there are no complications. Line by line addition, parent company current asset 3,000, subsidiary 4,000, altogether consolidated current asset is 7,000. So total asset is 42,400. Then stated capital. The stated capital that is appeared in the consolidated statement of financial position should always represent the parent company's stated capital only. So share capital or stated capital is $10,000. And then non-current liabilities. In this example, there are no information about non-current liabilities, so you don't need to worry about that. And you are given current liabilities, and there are no more adjustment for current liabilities. You can adopt line by line addition. So parent company's current liability 4,000 and subsidiary, that is Beta's current liability 2,000. Altogether, consolidated current liabilities $6,000. Right. So accordingly, equity and total liabilities equals to total asset, that is $42,400. That's it. Thanks for watching. Bye bye.